Merry Christmas and Happy New Year to everyone. Guys, welcome to my channel. In today's video, I'm going to cover off my 5 favorite ideas for ASX stocks in January 2021. So these are stocks I've got on my watch list, potentially going to pull the trigger on some of these. When I do, I will let you know, but enjoy the video, guys, and let me know in the comments below if you enjoy it. Make sure you subscribe, hit that notification bell, give me a like, and let me know what sort of videos you want to see in the future, guys. Let's get into it. So guys, please pause this, read this disclaimer. I'm not a financial professional. Obviously, please do not take what I say as advice. Please consult your financial professional. Okay, so the first idea I have on my watch list is Fortescue Metals, ASX ticker FMG. So what do? Fortescue Metals, guys, in short, is an iron ore company. They produce and explore and try and find deposits of iron ore. And obviously they mine it out of the ground, they put it on ships and they sell it overseas. For the most part, iron ore is used in the production of steel. So obviously probably their biggest customer is going to be China, who consumes and creates a lot of steel. So these guys are totally linked to that growth. As of this video, the share price is trading around $25.62. It's had a phenomenal run up, guys, as you can see, over the last few years, in particular the last year and a half. It's been a very, very good run. Iron ore has been very much in favor, and prices have been very strong. What I like about this stock, guys, is the PE ratio is still very, very, very manageable at 16.72. It's got a nice little dividend there of 6.99% as well. So obviously the price may differ to the day that you are buying, but this, guys, is a phenomenal company. Do not be scared even at these prices. I know that the 52-week range is quite large, obviously having dropped from $8.20 all the way up to driven up to $25.68. It's a big run. We're looking at this at all-time highs, but guys, this company its earnings are really, really good, so do not be scared of that. So guys, my investment thesis for this stock is very, very simple. Very strong iron ore prices have driven growth in this company. So it grew 75% over the last year, the iron ore price. And so obviously the great increase in this stock price is because of that. Okay, so 75% increase in its main in the price of the product is selling is huge, and so you would expect that company to appreciate at least that 75%, if not more. This was undervalued compared to its peers, so the likes of BHP and Rio. So this increase is more than justified given the 75% increase in the iron ore price. If you want to know what the iron ore price, guys, is, just Google it. There's lots of charts out there that report on this daily. Other things I like about this stock, guys, are almost 50% of the shares are owned by insiders. For the most part, Andrew Fortescue owns a huge chunk of those, and he's recently bought into the stock as well. So even at these prices, he sees that there's lots of upside, and he continuously invests in it, which is obviously what you want to see. If insiders are selling, that's generally not a good sign. When they're buying, that's a good sign. People aren't going to put their money, particularly insiders, in things that they believe will not appreciate, particularly in the short and long term even as well. Commodity stocks are well and truly back in favor, guys. So these lag, and then given the cyclical nature, they'll take off really, really quickly as the price of their input, the price of what they sell increases in a big, big way. And as you can see, iron ore has grown a lot. The stock is in a strong uptrend, so there's good momentum, and the dividend yield is between 7 and 7.5% at the moment. Obviously, the price increasing is going to change that figure, but a really, really strong dividend, guys. So particularly those of you that are looking for income, Fortescue Metals is something that you might want to look at. So guys, moving on to the second stock I'm looking at in January, Mortgage Choice Limited, ASX ticker MOC. So what do? Guys, in short, they're a mortgage and home loan broker. So any one of you who've gone and got a home loan through a mortgage broker, banks aren't really good at giving loans. They're very slow at it. They lack the expertise. They don't have that salesmanship that mortgage brokers who are incentivized to make loans. So mortgage brokers get paid when they write a loan, and then they get a trailing commission as well for the life of the loan. So it's a win-win agreement, and brokers are continuing to grow as a percent of loans written in Australia. So it's a full financial services organization as well, guys, helping Australians with their financial needs by delivering a range of financial choices teamed with expert advice. So the expert advice there is key, guys. That's why people go to brokers, that you're able to compare a wide range of loans, not just, you go to your bank who you've been with for years. They're not going to give you much choice. They're only going to show you what they have on their books. And anything else, they're obviously not going to show you because it's not in their interest to do so. With a mortgage broker, they're incentivized to do good by you, because if you borrow and then buy another house in the future, they're going to get that business as well. So definitely an industry I see growing in a big way. So they've got mortgage broking, financial planning, and other credit services. So obviously, though, guys, by far most of their money comes from residential mortgages and writing those. These guys facilitate loans between banks and lenders and yourself, the borrower. So it's currently trading at around $1.50, guys. It did drop off in a big way, and that is why I'm looking at this. I think it's undervalued, and while it has had a good run back up, it's well off its highs. It suffered a lot because of the Royal Commission into mortgages and into banking. Obviously, there were some big changes planned there, and Mortgage Choice was going to bear the brunt of it. So as you can see, it did drop down all the way to 52 cents. And so it's since recovered quite a bit. Still believe it's quite undervalued here, guys. Obviously its previous highs were at that $2.50, $2.60 mark. And well and truly, if its earnings continue to grow with a strong housing market and the industry itself of mortgage broking growing, it could see some significant upside here. It's got a very, very manageable PE of 20 times and has a nice little 4.73% dividend yield. It is on the smaller end of the spectrum, guys, so this is a bit of a small cap, $188 million market cap, so not a big company, not a tiny company either, but definitely on the smaller end of what I look at. So my investment thesis, or why I like this company: credit, being money, has never been cheaper to borrow, guys. So it means more people are able to borrow because they're able to meet the financial criteria of borrowing. And so Mortgage Choice is going to write more loans, which in turn is going to mean more revenue for the company. Housing construction are set to do really strongly this year. I'm not sure if you can see in your area, there's so much demand for housing at the moment. They're going to have to build more. People are moving around as well a lot because of COVID and into new cities. Like, I'm based on the Gold Coast, and the housing demand here is very strong. It's hard to rent, it's hard to buy, and prices are going through the roof. So that in turn normally means that mortgage companies are writing more loans as more people are borrowing, and also there's going to be lots of new homes, so more loans again. As I said, a nice dividend yield of 4.53%, which is fully franked, so you get that upside there as well, and a very undemanding PE of 19 times. So that's the reason I like Mortgage Choice, guys. This is one that I will probably pull the trigger. We're looking probably at a medium-term play. Short-term, it's probably going to do well, but given it has had quite a bit of a run-up, I wouldn't say there's a huge demand. Similar to Fortescue Metals, I'd say, guys. Buy this on any kind of a small pullback. So if there's a 5-10% correction in the market, definitely something that I would be looking to pick up. Northern Star Resources is my next stock I look at, ASX ticker NST. These guys are a gold production company, guys. So basically a gold company. They find gold deposits, they mine them, and then they sell the gold. Okay, very, very simple. They operate in Australia and North America. So a gold company. So the earnings of the gold companies are tied entirely to the gold price, guys. Currency also has a play in this. So Australian gold companies earn money in US dollars, but have expenses for the most part in AUD. What that means, guys, is if the Australian dollar goes up, these guys will actually be negatively impacted. Well, not negatively, but compared to what they currently are, negatively. So if the Australian dollar depreciates, they get a big tailwind. And the low Australian dollar of the last, say, 5 or so years has been a real big boom for these guys. On top of that, they've got the double whammy of the gold price going up. So as the gold price goes up, they make more money. Currency changes, they can also make or lose money. So given the currency differential has changed now, this is going to obviously impact their earnings, but the gold price has gone up. So I know this is a little bit tricky to understand, guys, but to be honest, while doing the research here, I've actually thought, you know what, potentially US-based gold miners who I can buy through stake. So, you know, like a Newmont Mining or Barrick Gold or one of those companies who are based in the US and have expenses in US dollars, they're probably going to benefit from this. Okay, so the inverse relationship will exist. But in saying that, this is a very, very good gold company, so we're going to dig into it. It's currently trading at 1366. I believe since I did the research for this video, it has dropped a little bit more. It's probably at that 1250 mark, and it's starting to look ripe, guys, for a buy. Okay, I think I'll be looking to buy this in the 11s. If it gets into the 11s, I will definitely be looking to buy. It's a decent sized company, $10.12 billion market cap. Obviously, you can see it does have a lot of peaks and troughs. It is cyclical because of the change in the gold price. P ratio of 36 times, but guys, this company is growing quite fast. So gold companies, because of the strong gold price, their earnings have been very, very strong. It also pays a little dividend yield of 1.43%, so that's a little kicker there. So here's my investment thesis, guys. It's an extremely well-run gold miner with a really, really strong track record of delivering shareholder value. So the price of this has been going up for many, many years. Obviously, it goes up, comes back a little bit, goes back up. I bought this stock at around $2 and I sold it at $9.80. And since then, I've bought in and out of it multiple times. To be fair, I probably would be better off just having held it. So that's a lesson for me. It has tons of cash on the balance sheet. This is what I've always liked about this business. They actually gush cash. So they produce so much cash and free cash flow. It's a really, really good sign. So the reason for this is strong earnings growth due to high gold prices. Worldwide money printing should result in much higher gold prices as well, guys. So any sign of inflation will be good for gold. And on top of that, we're in turbulent times and gold is considered a flight to safety. So it's good for any portfolio to have exposure to gold and Bitcoin and things like that, guys, because I guess they're uncorrelated assets. So when the market is doing well, these are normally doing badly. And when the market is doing badly, the other things are doing well. So it's kind of offsets it. And it's a way to play, I guess, this printing that's going on, which is absolutely crazy and diminishing the value of our dollars. So the next company I really like, guys, is Appen, ASX ticker APX. So Appen, they've basically been branded as an AI or machine learning business. So obviously a huge area that's growing in a big, big way. Appen collects and labels images, text, speech, audio, video, and other data used to build and continuously improve the world's most innovative artificial intelligence systems. So these guys create, label and obviously give additional data to artificial intelligence machine learning systems. So a good example is Google. They provide lots of additional information to Google to improve the relevance of their AI and their machine learning. Okay, so to give us more and more relevant search terms, their search results, sorry. So when we type something into Google, Appen has fed a lot of that data and given it to Google. So they've got some really, really big customers like Google. So obviously this has had quite a big drop off, guys, from its 52-week high of 43.66. It's now trading back at 24.98, and as of today, I believe it's at $22 something. So it's dropped even more since this. Very high PE ratio, but the company's growing really fast, guys, and that's why it's got that PE ratio. It has counted some few problems, which we'll get into. Its market cap is around that $3 billion mark, but this is something, guys, that will continue to grow a lot over the next few years. So as for an entry point, I think this could go as low as probably $18, $19. If it gets anywhere near under the 20 mark, I'll probably be buying. To be honest, now that it's at that $22-ish mark, I will be buying a small, probably 50% stake. And then if it continues to drop down around that $18, if it finds support around there, I will buy again. Okay, so if you have a look at a chart, I will be doing a bit more technical analysis in coming videos, but definitely, if you look at the charts, yeah, this could definitely drop all the way to, 17, 18 bucks. So my investment thesis, the speech and image segment decline should be temporary. So in their last earnings update, speech and image, which is one of their segments, has experienced a decline in revenue and profit. So I believe this to be temporary, and the long-term thesis for this business is still very, very strong, and it should see a lot of growth as the businesses that it deals with will continue to spend in those areas. So what's happened now is sales cycles have extended, and businesses where, say this is not the most important part of their business, they've kind of gone, you know what, we're going to wait to make a decision. We'll see when there's a bit more certainty and see what happens with the pandemic. They play in an industry that's growing very fast though, guys. So without a doubt, they will have more customers, and their existing customers will spend more in the future. And the share price seems to slowly be stabilizing. Okay, so it did drop very, very fast, but this stock does see a lot of ups and downs. Totally normal for this stock to see a big drop off. Something happens and they're able to correct it, and the next earnings update is very, very strong. The stock takes off. So probably want to wait and see what happens in the next earnings update. It will rocket that day though. So if you haven't bought in before, then it may rocket very quickly, but just watch the following few days. It will pull back a little bit and get in then. So guys, definitely take a look at Appen. Our next stock is Woodside Petroleum, ASX ticker WPL. What do? Plain and simple, guys. They're an oil and gas company. They find oil, they pull it out of the ground, and they sell it in barrels. It's trading around $23.51. This has definitely picked up in the last couple of weeks, guys. It's got a decent market cap, 22.62 billion. It's definitely the bigger oil company in Australia. As you can see, the 52-week range is huge. So it went from $14 to $36 all the way to $14, guys, and it's now obviously kind of taken back half of that. But all we need is a good little uptick in oil prices, and this will rocket, and that's happened of late. So it's got a good forward dividend yield of 5.25% as well, guys. So it does pay a nice little dividend. My investment thesis is pretty simple. Oil was one of the hardest hit industries on the ASX 300 during the COVID crash. So the rotation into what's called the recovery trade at the moment. So all the stocks that did very poorly out of COVID, and now the economies are slowly opening back up, the recovery trade is where people are heading and spending more buying more stocks in that space. Woodside will benefit from that. It's a big oil and gas company. Oil and gas is still needed in the world regardless of renewables, and it probably will be for quite some time. The price of oil and gas has been beaten up, so it's also gas. So they obviously sell LNG and those type of products as well. And it is obviously the safer play on the ASX due to its size and it's the strength of its balance sheet. There's lots of other ways you can play the oil price, but this is the safest. 2021 looks like it'll be a year of vaccines and strong economic growth. So guys, there's 5 ideas to add to your watch list. I don't know if you like them. Let me know below. Please give me some more ideas. I do enjoy the comments you guys give me. I'm really enjoying watching this channel grow, and I will see you in the next video, guys.